Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cmoc Group Limited Annual Report. Cmoc Group Limited offers a diverse range of businesses and services across various sectors. The company operates in 5 main segments: molybdenum, tungsten and related products; niobium, phosphorus and related products; copper, cobalt and related products; metal trading, and others. In the mining sector, Cmoc Group Limited engages in the extraction of base and rare metals such as copper, cobalt, molybdenum, tungsten, and niobium. The company also offers phosphate fertilizer and trades in base metals, molybdenum, and tungstenic products. Additionally, it provides services such as selection, processing, refining, and sale of mineral products. Beyond mining, Cmoc Group Limited offers a range of value-added services including import and export of goods and technology, consulting, asset and investment management, enterprise operation and management, technology services, logistics transportation, technical services, software development, and hotel operation activities. The company operates globally with a presence in over 30 countries across Asia, Europe, Africa, and the Americas. Overall, Cmoc Group Limited's business portfolio is extensive and diverse, reflecting its position as a leading player in the global mining and metals industry. Cmoc Group Limited market capitalization of $408 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Cmoc Group Limited holds a significant advantage in their industry. Cmoc Group Limited trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 4.13 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to an increase or decrease in revenue. On the growth side, the acquisition of Lumina Gold Corp. And its subsidiaries has been a significant driver, as well as the refining and sales of mineral products through Huyu Nickel Cobalt and Cmoc Metallurgical. Additionally, external revenue from various countries such as Congo, DRC, Brazil, and China have also shown growth. On the decline side, the decrease in sales of goods by CATL and Fuchuan has been a major contributor to the decline in revenue. The rendering of services by Yulu Mining remained stable, but this was not enough to offset the losses incurred by these companies. Furthermore, external revenue from Switzerland business also decreased, contributing to the overall decline. It is worth noting that some drivers of growth or decline may not be significant and could be due to various factors such as changes in investment values, interest income, or other non-operating items. However, the acquisition of Lumina Gold Corp. And the refining and sales of mineral products through Huyu Nickel Cobalt and Cmoc Metallurgical have been key drivers of revenue growth. The change in net income and profit margins from 2024 to 2025 presents a contradictory picture. On one hand, net income increased by 50.79% according to page 8, indicating a significant improvement. However, other sources suggest a decline, with a decrease of 3% on page 256 and 43.3% on page 280. Similarly, profit margins show mixed results, increasing by 6.38 percentage points from 2023 to 2025, but decreasing by 2.5 percentage points on another page. The reasons behind these changes are not explicitly stated in the provided summaries, leaving room for speculation and further analysis. The conflicting information across different pages highlights the complexity of financial data and the importance of verifying sources to ensure accuracy. Despite the inconsistencies, it is clear that net income and profit margins underwent significant fluctuations between 2024 and 2025, with no clear indication of a consistent trend. The company's ability to generate positive operating cash flow has been a consistent theme throughout various sections of the report. On multiple occasions, it is stated that the company is indeed producing positive operating cash flow, with net inflows ranging from RMB 20,843,061 to RMB 368,539,020.46. These instances suggest that the company's operations are generating sufficient cash to cover its expenses and investments. However, there are also some contradictory statements indicating that the company is not generating positive operating cash flow in certain periods. For example, on page 127, it is stated that the company is not producing positive operating cash flow. Similarly, on page 333, it is noted that the operating cash flow is negative. These discrepancies may be due to various factors, such as changes in business operations or fluctuations in market conditions. Despite these inconsistencies, the overall trend suggests that the company has been generating positive operating cash flow for most of the periods analyzed. This is a crucial indicator of the company's financial health and its ability to sustain its growth trajectory. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the total debt increased from RMB 13.96 billion to RMB 43.19 billion, indicating a substantial rise in debt. However, this trend was later reversed with a decrease of 9.1% in debt level, bringing it down to RMB 23.38 trillion. In terms of interest expenses, the company has consistently reported a decline. Interest expenses decreased from RMB 4.04 billion to RMB 2.63 billion, followed by further reductions to RMB 238 million and RMB 2.12 billion. The net financial expenses also saw a significant decrease of 60%, indicating a substantial reduction in interest expenses. Overall, the company's debt level has fluctuated over the past year, with an initial increase followed by a decline. However, the interest expenses have consistently decreased, suggesting that the company is making efforts to reduce its financial burden. The performance of various segments and regions in the company's operations has been mixed. On a positive note, South America has seen significant improvements with enhanced niobium recovery rates and phosphate business structure in Brazil, as well as accelerated development at Odin Mining. Similarly, China has optimized its capacity layout at Sandiazhuang and Shangfenggu and advanced joint mining operations. However, there are areas of concern. In Asia, investing activities have been negatively impacted by a 47% decrease in cash receipts from disposals and recovery of investments. Globally, operating activities have also suffered with a 5.4% decline in cash receipts from the sale of goods and services. Furthermore, other cash receipts relating to investing activities globally have decreased by 58.6%. These underperforming areas will require attention to ensure overall growth and success. Management is optimistic about the company's outlook, citing record highs in operating performance and core product output. They expect the gold sector to become a new growth driver for the company, with plans to put the Odin Mining Gold Project into operation by 2029. The Brazilian gold mines are expected to achieve significant production levels, with an annualized gold production of 6-8 tons in 2026. Management is guiding for the production of various metals and minerals, including copper, cobalt, and gold, as well as physical trade volume. They believe that the company's strengthened gold resource portfolio will drive results growth. In terms of distribution, management plans to distribute at least 80% of profits in cash if there are no substantial capital expenditures, or at least 40% in cash otherwise. The company has expanded its operations through strategic acquisitions, focusing on mining and processing activities. This expansion is expected to contribute to the company's growth and profitability. Overall, management's outlook suggests a positive trajectory for the company, driven by its gold sector and diversified production portfolio. The company's financial activities have been quite active in recent years. One notable aspect is its dividend payment history. As per the provided references, it is clear that the company has indeed paid dividends to its shareholders. This is evident from page 127, which states that a significant amount of 5,783,000,000 $522,868.72 was distributed as dividends in 2025 alone. In addition to paying dividends, the company has also been involved in share buybacks. According to page 251, the company has repurchased and canceled a substantial number of shares, totaling 104,930,443. This indicates that the company is actively managing its capital structure by reducing the number of outstanding shares on the market. Overall, these financial activities demonstrate the company's commitment to rewarding its shareholders through dividend payments and optimizing its capital structure through share buybacks. The company's inventory levels are a cause for concern. The significant values of raw materials, work in progress, and finished goods on page 210 indicate that the company may be holding too much stock. This is further supported by the fact that raw materials increased by RMB 77,791,560.19, while finished goods remained unchanged. Moreover, there are also concerns about supply chain disruption. The reliance on in-transit and historical stocks due to smelters' inability to access new supplies, page 24, highlights a potential vulnerability in the company's supply chain. Additionally, the decrease in consumable biological assets in Brazil, page 211, suggests that the company may be facing difficulties in sourcing certain materials. The situation is further complicated by the fact that cobalt inventories have fallen outside of the DRC, where most of the world's cobalt is mined, page 24. This could lead to supply chain disruptions and make it difficult for the company to meet its production needs. Overall, these concerns suggest that the company may be facing significant challenges in managing its inventory levels and supply chain. That concludes the financial summary for Cmoc Group Limited. Feel free to comment below, and I will be happy to answer them when possible.